Okay, let's start. Accounting ratios. Already we discussed the meaning of accounting ratio, objective accounting ratio. You know all the things. Then advantage of a ratio analysis. You have to read this and this limitation of ratios. Last class we have discussed and types of ratios. We already discussed types of ratios, liquidity ratios, solvency ratios, activity ratios, profitability ratios. Okay, liquidity ratio, under liquidity ratio, there is a current ratio. We know what is current ratio and how to calculate current ratio. When already we discussed or about the illustration number 1 last class about the current ratio. Okay, we already done this, and then quick ratio we already done this quick ratio already. Illustration 2 we already done. Illustration number 3 liquid ratio from the following information, isn't it? And what about this illustration number 4? We already discussed it. Okay, now okay, we also discussed the list number 6. That means there are state the giving reasons which of the following transaction would improve, reduce, or not change. Payment of current liability we already discussed. Okay. Last class up to this. I think last class we discussed up to chapter illustration number 6, isn't it? Hello, Rokaya Khatun, are you there?
Yes, sir.
So I think last class we discussed illustration number 6, last problem, isn't it?
Yes, sir.
Okay.
Uh, 6.
Solvency. Today we'll discuss solvency ratio. Okay. That means liquidity ratios done. Now we'll discuss the solvency ratio. Okay. Solvency ratio. So what is solvency ratio? Any idea? I think we also discussed this solvency ratio, isn't it? Long-term debt divided by shareholders fund. I think we already discussed it. Illustration 7 also done, isn't it? Or you forget it? My remember is that I already discussed illustration number 7 also. Hmm? Is it solvency ratio?
Maybe not, sir.
Just check your note khata. You can find whether it is solved or not. But
No, sir. 6.
up to 6, not 7.
Mm.
Okay, if not, then I will discuss it again, no problem. So solvency ratio. What is solvency ratio?
Sir,
Hmm. Rokeya Khatun.
ability to meet its long-term debt
Right. Ability to meet or prepay its long-term debts or liabilities. Okay.
obligation.
Okay, obligations. Okay. So the following ratio are normally computed for evaluating solvency ratio. First of in under solvency ratio, we have to compute debt equity ratio, debt to capital employed ratio, proprietary ratio, total asset to debt ratio, interest coverage ratio. Total 5. Under solvency ratio, total 5 ratios to diagnosis the solvency of an organization of an entity. You have to determine or compute these 5 type of ratio to check the solvency. Okay. So first of all, debt to equity ratio. What is the debt to equity ratio? Debt to equity ratio, the ratio you already it is given, debt and ratio between debt and equity. Okay. So the formula is long-term debts divided by shareholders funds. Okay. That means long-term debts divided by equity, shareholder equity. Okay. Okay, there is a thumb rule. Thumb rule is normally it is considered to be safe if debt equity ratio is 2 is to 1. Okay. Normally it is considered to be safe if debt equity ratio is 2 is to 1. That means if 2 is to 1 means long term debts, and is it 2, is it debt or equity? What do you think? And 1 is, it is debt or equity? I think this 2 is equity and 1 is debt. Okay. Hello. Or this is debt or equity. What is the rules? Your long-term debt is 2 times then your shareholder funds, or your shareholder funds should be 2 times compared to your long-term debts. Okay. However, it may vary from industry to industry, but it may vary because banking industry, they dealings with all are debt, isn't it? Or because say clients or customer deposit the money to the bank, it is debt for bank, and that in that case this ratio is not applicable, this standard is not applicable. On other hand, for corporates of, say for example, pharmaceuticals, or in toilet or any other company, say for example some manufacturing company or some company like RFL or Square Toiletries or Square Pharmaceuticals, Beximco, Leather Company. So they may maintain this standard. Okay. So the formula is long-term debts divided by shareholders fund, where shareholder funds equals to share capital plus reserve and surplus plus money received against share warrants plus share application money pending allotment. These are the all shareholders funds. Okay. You got this? Hello. Hello. Are you there?
Yes, sir.
Yes, sir.
Hello. 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 Hello.
Yes, sir.
Are you hear my voice?
Yes, sir. Clear.
Okay, 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 okay. Because right now our electricity come and I connected my Wi-Fi. Okay. So let us start again. Mhm. Okay. So shareholder funds, these are the components of shareholder funds. And what is share capital? Share capital equals to share equity capital and preferential capital. Or shareholder funds equals to non-current asset plus working capital minus non-current liability. You can determine shareholder funds in this way also. You can determine by sum of these things, or you can determine shareholder funds equal equity equals to non-current asset plus working capital minus non-current liability. Working capital, what is working capital? Current asset minus current liabilities. Now, what is the significance of debt to equity ratio? These ratios measure the degree of indebtedness of an enterprise and gives an idea to the long-term lender regarding extent of security of the debt. So, this ratio give you the idea about the debt degree of indebtedness. That means whether it face in future any bankruptcy issue or insolvency issue or not. And that my idea is long term. And regarding the extent of security of the debt, see if the lender give the money to the company, whether they can return this money or not. In this way, we can assess of that company. Okay. So it indicated earlier. Okay. So there is a illustration. If we solve one problem, we can understand very easily. Okay. Illustration number 7. From the following balance sheet of ABC Company Limited on March 31st, 2015, calculate debt to equity ratio. So there it's given on balance sheet item. Okay, balance sheet item. ABC Company balance sheet 31st 2017, equity, liabilities, equity and liability. First of all, shareholder funds is this is shareholder funds. This non-current liabilities. These are the non-current liability. That means long-term liability, long-term borrowings, and this is current liabilities. Total 225 lakh. And asset, non-current asset, that means fixed asset, long-term asset, and this is current asset. Okay. Solution. Uh, from this balance sheet, you have to calculate debt to equity ratio. Okay. Hello. Are you understand this problem?
Yes, sir.
Okay. So how to, what is the formula? Debt to equity ratio. Debt divided by equity. Debts divided by equity. Debts equals to long-term borrowings plus other long-term liabilities plus long-term provisions. These are all are debts. That means non-current liability. Long-term debts. 4,40,000, 60,000. Okay. 4,40,000, 60,000. Total 5 lakh. Okay. Now divided by equity. Equity means share capital plus reserve and surplus plus money received against share warrant. So these are all are the equity. These these are all are the equity. Okay. So these are all are the equity. Okay. And if you divide, sorry, just a minute. Hello. Uh, class, okay. Okay. হ্যাঁ খেজুর কিনে আসবো হ্যালো
Yes, sir.
so so this is total equity. Share capital reserve and equity is 15 lakh. Okay, this is 15 lakh. Long term liabilities, equity. this 15 lakh. Then if you calculate, if you divide this 50,000, debt is 5 lakh, isn't it? 5 lakh or 50, this is 5 lakh and equity is 15 lakh. Okay. Then answer is 0.33:1. What does it mean? That means if your debt is 33% against your asset, isn't it? Or equity. Your debt is 33% against your equity, isn't it? Hello? Hello?
Yes, sir.
Have
Sir.
you got this problem?
Yes. Yes, sir.
Yes, sir.
That means your debt, that means long-term debt is 33% against your equity, shareholder equity or equity. So how do you think? Is it good or bad? Or if you interpret this result, how you interpret? Hello? How you interpret this result? 0.33:1. I think it's quite satisfactory because against equity, your long-term debt, it is only long-term debt, not long short-term debt. Long-term is 33%. So you can repay your long-term debt by your equity, isn't it? You have the ability. What do you think? Isn't it? So this is your long-term debt, that means external liability, and this is your equity, that means internal this is external financing, this is internal financing. Your internal financing, that means equity is almost 3 times higher than your external finance, isn't it?
Yes, sir.
Okay. So you can, if any obligations or any or all the non-current liabilities you need to pay, then you can pay, no problem. Okay. So because your compared to your non-current liability, your shareholder funds is much more strong or higher. Okay. Okay, this is all about our equity to debt to equity ratio. Now illustration number 8. What about it? From the following balance sheet of a company, calculate debt. Same thing. Debt to equity ratio. Same. So here they also given the balance sheet. Here is a balance sheet, shareholders funds, and then notes 1. It is for reserves and surplus. Then share an application for maintaining, okay, to non-current liability, that means this is long-term borrowings and this is current liabilities. Asset, non-current asset, current asset. Notes to accounts 1. Share capital. Equity share capital 6 lakh and preferred share capital 2 lakh. Total 8 lakh. That means this 8. Total out of 8 lakh, your share capital, equity share is 6 lakh and preference share capital is 2 lakh. Only two. What about others? Only two joined with us. What about the others 4 participants? Why then? হ্যালো,
স্যার আমরা টোটাল স্টুডেন্ট দুইজনেই আছি ক্লাসে।
হাউ অ্যাবাউট আদার্স?
তারা জয়েন করেনি।
জয়েন করেনি? They are
Maybe.
busy. They are busy because now it is the time of, I think, shopping or other things. They are more busy shopping or other activities rather than participating in online class, isn't it? So this is the
Maybe.
I already told about this. This is the problem of online class. Everybody are very reluctant and very not interested in online class. Very effective, not sincere about the online class, isn't it? By the way, what can I do? We have to continue our class as per rules and regulations, as per obligation of the universities. We have to continue within two students. Okay, now is illustration number 8. We have to compute same things, debt to equity ratio. Okay, there are two note. One note about the share capital, another note is about the fixed asset. That means here they mention fixed asset, tangible asset 11 lakh. Now, tangible asset, out of tangible asset, they break down their plant and machinery 5 lakh, land and building 4 lakh, motor cars 1 lakh 50,000, and furniture 50,000. Total 11 lakh. This breakdown of this 11 lakh. Okay, this and now solution solve. How to solve this? To debt to equity ratio. We know the formula. So long-term debt divided by equity, shareholder equity funds. So long-term debts, it is given, isn't it? Non-current liabilities, long-term borrowings, 1 lakh 50,000. This 1 lakh 50,000. 1 lakh 50,000. Now, equity equals to share capital, reserve and surplus, share application money pending allotment. Total 11 lakh. This 11 lakh. 8 lakh, share capital, reserve 1 lakh, 3 lakh, and share total 2 lakh. That is this 11 lakh. Okay. So, answer is 0.136 is to 1. That means debt is 13.6% against equity, isn't it? 13.6%, isn't it? And earlier, last problem, debt was 33%, but this problem debt is 13%. Which one is better? What do you think? First one or second one?
Second one.
Second one, because is the proportion of debt is much lower than first one, isn't it?
Yes, sir.
Mm. Okay, good. So rules is, if your internal financing, that means equity share is more strong than your debt financing, then you in safe position, not in danger position. But if your debt external financing, the long term borrowing is proportion is higher in compared to shareholder funds, then you may face some problem if you not manage it. Because if you manage it, no problem. But if there is some mismanagement, or and then you may face some danger or risky position. Now, second component of solvency ratio is this debt to capital employed ratio. First one is debt to equity ratio. Second one, debt to capital employed ratio. Okay, what is the formula? Debt to capital employed ratio. Debt to capital employed ratio equals to total debt equals to total asset. Total debts here, long-term debts plus current liability. Earlier on, we already consider long-term debts. Now, if you compute debt to capital employed ratio, here you consider total debts. Total debts means current liabilities plus long-term debts and equals to so divided by total asset. Okay, divided by total asset. You know the total asset is for this balance sheet. Total asset is this 25 lakh. Okay, total asset, current asset and long term asset. So there is no problem or no illustration for this debt to capital. Okay, capital. Okay, no problem. We'll move forward. The third one, proprietary ratio. What is the formula of proprietary ratio? Shareholders' funds divided by capital employed or net asset. How to calculate net asset? Net asset means equals to hello. You know the net asset, capital employed or net asset. Net asset means if you from your asset, if you deduct this non-current liabilities, then
Asset minus liability.
that means you can get, then you can get the net asset or shareholder equity. This is also the shareholder equity is also called the net asset. Okay. Capital employed, that means capital employed, either capital employed or the net asset, same amount. It should be same. Okay. Significance or the proprietary ratios, what is this? We need this significance because you can compute the formula, no problem, but problem is to analyze it or interpret this result with rational manner or with what is the problem, with the rational manner or with the that is judgmental. If you give any interpretation, the decision maker or the user can easily judge this result and take the decision. Okay. Higher proportion of shareholders fund in financing in the asset is a positive features as it provides security to creditors. Okay, you already know this. Higher proportion of shareholder funds, it is applicable for everyone. Debt to capital employed ratio and then debt to equity ratio, all are same applicable for this. Okay, so higher proportion of shareholder funds in financing assets is a positive features as it provides security to creditors. Okay, this ratio can also be computed in relation to total asset instead of debt asset. Okay, it may be the noted that the total of debt to capture employee ratio and property ratio is equal to 1. Okay, okay, they analyze this. Okay, and then total asset to total debt ratio, very simple, total asset divided long term debt. Total asset to debt ratio, total asset divided by long term debts. Okay, now illustration, we will interested in illustration. Okay, in this illustration number 9, how many illustration here? 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19. 23, 24, 25, 26. 26 problem. Oh my god, so many problems, so many illustrations. It's good because if more you practice illustration, more you learn. Okay, then there is a summary, then question for practice and long term question, and there is some problem, that means some exercise here also. Good, this is good, and also answer given here. Good, there are so many exercise also. Very good. Okay, so if this sheet or this lecture sheet is good for you because after every ratio they give the example illustration so that you can understand very well, isn't it? Hello,
Yes, sir.
it is good for you. So you already we discussed how illustration number 6 9, isn't it? No, 9. Illustration number 8 already complete. 8, yes, 8. Now illustration number 9. This illustration number 8, from the following information the calculate the debt already we done, debt to equity ratio, total asset to debt. Okay, there are property ratio and debt to okay. Oh, now they accommodate all the 4 ratio, that means debt to equity ratio, total asset to debt ratio, property ratio, and debt to capital employed ratio. Okay, so first of all, debt to equity ratio, you know the formula, debt divided by equity, long term debt divided by equity, and this is 3.3 is to 1. Total asset to debt ratio, total asset divided by long term debt. Now now you have to determine total asset. Total asset here 7 lakh, isn't it? 7 lakh. So total is 7 lakh, and equity, long term debts we already computed here. Long term debts, is 1,50,000. 1 lakh, answer is 4.67 is to 1. Armani, what do you mean this answer? 4.67 is to 1 total asset to debt ratio. So against your debt, your asset is 4.67 times higher, isn't it? Hello, you understand it? Hello.
Yes, sir.
Okay, net is slow or some problem in net issue. Okay, now proprietary ratio, shareholders funds divided total asset. Total asset we know 7 lakh. This is 7 lakh, and shareholders fund 5 lakh. Where is the shareholder fund? This shareholder funds 5 lakh. This 5 lakh. Total 5 lakh. So answer is 0.23 is to 1. That means your long-term debt against your capital is employed is 23% or 23%. Yes, 23%. Now illustration number 10. The debt equity ratio of X Limited is 0.5 is to 1. Which of the following would, this is good as question. I like it because this is conceptual type of problem, question. So if you know it and the formula and how it affect the result, then you can interpret it easily. Okay, the debt equity ratio of X Limited is 0.5 is to 1. That means your if your equity is 1 and your debt is 0.5, so is 50%, debt is 50% or half. Okay, which of the following would increase, decrease, or net or not change debt to equity ratio, like current ratio. We already done this type of problem about the current ratio, and this is for equity debt to equity ratio. So first of all, furniture issued of equity shares. Sorry, further issues of equity shares. So they issue more share. Okay. If they issue more equity share, what is the impact of this result? It will increase or decrease or not change. What do you think? This 0.5 increase or decrease if you issue further equity share? Are you there? Nurzahan Akhtar and Jibin Tasmin. Are you there?
Yes, sir.
Yes, sir, I'm here.
Okay, I think your net is not a net issue. You have not connected effectively earlier on.
Yes, sir, my net is very unstable.
Unstable. Okay. Now your net is stable, isn't fixed it?
Okay, sir, I'm trying.
No. Okay. So what is number one? Further issues of equity shares. What is the impact? Equity, your debt to equity position increase, decrease, or not change? Rokeya Khatun, can you answer this problem? Further issue of equity shares. Answer is given here. Answer is given here. But at first, going to the answer, you just interpret yourself, just check yourself whether you can solve it or you can think it positively or not. Okay. So they give the answer, assume that 1 lakh worth of equity shares are issued, a new 1 lakh share equity share is issued. These will increase the internal fund 11 lakh, isn't it? Earlier the internal fund was, say for example, let the external fund 5 lakh, that means this 50%, isn't it? And internal funds 10 lakh, that means this is 1 is 10 lakh and 50% of 1 lakh sorry 10 lakh is 5 lakh external long-term debt. Okay, then if you increase 1 lakh worth of equity share, then your internal for equity share will be 11 lakh, this 11 lakh, and your external financing or external financing as it was, that means 5 lakh 5 lakh. Okay, this 5 lakh. Now your ratio will be 0.545 is to 1. That means your earlier was it is 0.5 is to 1, now it is 0.5 is to 1. This it is clear that further issue of equity shares decrease the debt equity ratio. All of you got this? Hello? All of you got this?
Yes, sir.
Any problem to understand? That means it is very easy. If you, that means if further issues of equity shares, it increase or decrease your debt to equity ratio. That means it is good for you. Next, cash received from debtors. Okay, so debtors means so if you that means they return their, so debtors, cash received from debtors. Who is the debtors? This is debtors. This is not debtors. This is debtors. Debtors.
Person,
That means you earlier you loan it. Now they pay this amount, isn't it? Hello?
yes, yes, sir.
Then what is the impact of this? If you receive money from your debtors, then it will increase or decrease or no change in debt to equity ratio. Cash received from debtors will leave the internal external funds unchanged, as this will only affect the composition of current asset. Yes, if you receive cash, it increases your current asset, isn't it? Hence, the debt equity ratio will remain unchanged. Though debt equity ratio will remain unchanged. But one thing, if debtor return his money, then it cash is increased, no doubt about it. That means current asset would be increased. But there is no change in long-term debts and equity, isn't it? Hello? You understand?
Yes, sir.
Yes, sir.
That means you debtors, that means you, this is short term. That means you sell product or sell inventory on account earlier on. Now they give you money. There is no effect in the debt to equity ratio, isn't it? Hello?
Yes, sir.
Have you got this?
Yes.
No change in debt to equity ratio. Now, redemption of debentures. Now, this will be effect, either increase or decrease. What will be the debt equity ratio? If the redemption of debentures, that means you pay the debentures amount. Your debentures now decrease. That means debt is decrease, isn't it? Debt will be increase. So, debt will be decrease. If debt decrease, I think it will decrease or increase, decrease debt to equity ratio, isn't it? Or there is no change. Hello? We ignore sale of goods on cash basis. We ignore this. Number
Yes,
3.
sir.
Okay, okay. Sorry, I just skip this number 3. Number 4. Okay, number 3. At first, we solve number 3. Sale of goods on cash basis. What will be the effect? No effect in debt to equity ratio, isn't it? Hello? Is
Yes, sir.
sale of goods on cash basis, is there any change in the debt to equity ratio? If you sell of goods on cash basis, you receive money, this is not change your debt and equity, isn't it? So no change. Number 3, no change. All of you understand this? Number 3. Hello?
Yes, sir.
Yes, sir. Okay. Number 4, redemption of debenture. It obviously affect that debt to equity ratio. How do you think? Isn't it? Even redemption of debentures, it will increase or decrease? Decrease. Okay, very good. Decrease. So it will decrease the debt equity ratio. Okay. Number 5, purchase of goods on credit. Is there any effect on this debt to equity ratio, purchase of goods on credit?
Unchanged category.
I think no change, isn't it?
Yes, sir. Unchanged.
Unchanged. Okay, that's on question number 10. Now, interest coverage ratio. It is the ratio. It is a ratio which deals with the servicing of interest on loan. That means whether you have the ability to pay the interest or not. That means earlier on is your debt. You have enough money or enough shareholder equity money against your debt, but now if you collect money by issuing bond, debenture, now the question is that whether you have ability to give the interest or not. This is called interest coverage ratio. Okay, so our formula is net profit before interest and tax, or it is another name is EBIT, earning before interest and tax. Okay. Hello.
Okay, sir.
Divided by interest on long-term debts. Interest on long-term debts. That means the interest part. The interest part. So if you divided EBIT to interest, then you can calculate interest coverage ratio. So on its significance, it reveals the number of times interest on long-term debts is covered by the profit available for interest. A higher ratios ensure safety of interest of debt. The higher the ratio, higher the safety. Higher the ratio, higher the safety for interest coverage ratio. Okay, from the following details, calculate the interest coverage ratio, net profit after tax. That means EBIT 60%, 15% long-term debt is 10 lakh, and after tax rate is 40%. So you have to calculate interest coverage ratio from this. So it is net profit after tax. They are given net profit after tax, and you note you need net profit before tax, isn't it? Interest and net profit before interest and tax. They given the interest rate and also given the tax rate. Now you convert it EBIT. Okay, so net profit after tax is 60,000, tax rate is 40%. So net profit before tax is 1 lakh. So 1 lakh is your net profit before tax. After your tax is 40%, that means 40,000 out of 1 lakh, 40% is 40,000, then 60,000 is net profit after tax. Okay, then interest on long-term debts, 15% of 15% of 10 lakh. Okay, 15% 10 lakh is 1,50,000. Okay, so interest 1,50,000 is the interest. Okay, net profit before interest tax. So 1 lakh plus 1,50,000, 2,50,000. 1 lakh is your net profit before tax, and 1,50,000 is your interest. Total 2,50,000. So net profit before tax is 2,50,000 divided by your interest 1,50,000. It is 1.67 times. So you have your ability to pay the interest is 1.67 times from your interest before interest, sorry, and earning before interest and tax. Okay, you got this?
Yes, sir.
Okay. Now the third type of ratio, which is called activity ratio. Under activity ratio, you have to do 6 ratio. That means turnover ratio, inventory turnover, it gives you then trade receivable turnover, trade payable turnover, investment turnover, fixed asset turnover, working capital turnover. So what is the significance of activity ratio? These ratios indicate the speed at which activity of this business are being perform. So say for example, some debtors or creditors, they assess this because whether how fast you pay your debtors money, how fast you pay your creditors money, how fast you can sell, that means inventory turnover. Okay, how fast you can collect money from your creditors, isn't it? Hello, you got this? Hello.
Yes, sir.
So inventory turnover ratio, first of all, inventory turnover ratio, what is the formula? Cost of revenue from the operation divided by average inventory. Inventory turnover, what is the formula? Formula is cost of revenue from operations divided by average inventory. That means it is cost of goods sold, isn't it? Hello. Another name is cost of goods sold divided by average inventory. Okay.
Yes, sir.
So this is the formula of inventory turnover. The significance, you can read the significance because it studies the frequency of conversion inventory of finished good into revenue from the operation. So this is the illustration number 12. From the following information, calculate the inventory turnover ratio. Inventory in the beginning inventory 18,000, inventory at the end 22,000, net purchase 46,000, wages 14,000, revenue from the operation 80,000, then carries inward 4,000. Now from this information you have to calculate inventory turnover. How to calculate inventory turnover ratio? Cost of revenue from operation. Cost of revenue operations, if inventory in the beginning plus net purchase plus wages plus carries inward minus inventory at the end. That means cost of goods sold. This is the cost of goods sold. The cost of goods sold, the formula is opening inventory plus net purchase plus wages. You can add wages also. This is also direct cost associated with the purchase. Okay, carries inward is say for example import duty or is transportation import duty also you can include here. Transportation in, that means transportation to read carry the your purchased good to your warehouse, it is called carries inward. You have to add this minus ending inventory, then you can got this cost of revenue from operation or cost of goods revenue from the operation. So and then average inventory opening inventory plus ending inventory divided by 2. Okay, this is average inventory. So this is turnover. 60,000 is cost of revenue from operations and the 20,000 is the average inventory. Just answer is 3 times. That means what is the interpretation of 3 times? Interpretation is you can convert your inventory into cost of goods sold or cost of revenue from operation in 3 times. Okay, the more times you convert your inventory to cost of goods sold, it is beneficial for your organization. Because if you in your in warehouse you have the stock of inventory but it is not unsold, this is not benefit or this is not good for your company. If you can convert this inventory to the cost of goods, so that means you can you able to sold it, then you can your liquidity position will be increased. You can earn money, and you can after that you can again purchase inventory and then sell it. So your cycle will be faster. So then your liquidity positions and these activities ratio, inventory turnover ratio is good. Okay, you understand? Your class time up to what? Up to 3:30,
Yes, sir.
3:30.
Starting at 3.
So Ruqayya Khatun, your net may be slow, or you not clearly. I not clearly hear your voice. Okay, you got this inventory turnover. Hello. So another illustration number
Yes,
13
sir.
also inventory turnover. You can do it yourself. And illustration 14, it is also inventory turnover ratio. You can do yourself. Then trade receivable turnover ratio. So another name of trade receivable is the receivable turnover. Same thing, trade receivables or receivables. Anyone can you can use. Okay. So what is the formula of trade receivable turnover? Number. Okay. Formula is trade receivable turnover ratio is net credit revenue from operations. Okay. Divided by average trade receivable. The net credit revenue or net sales divided by average receivable, opening receivable plus ending receivable divided by 2. Then you can convert it to average. Okay. Where average trade receivable is opening debtor average trade receivables. That means average trade receivable, opening debtors bid receivable plus closing divided by 2. Okay. So if you convert it into the number of days, you can do it by number of days or month divided by trade receivable turnover ratio. Then you can convert it into the days. We will solve on illustration. That means illustration number 15. Calculate trade receivable turnover. Okay. Total revenue 4 lakh. Cash revenue from operation 20% of total revenue. Okay, total revenue is 4 lakh, but out of 4 lakh, cash revenue is 20% of the total revenue from operation, and 80% is on credit or credit sales. Trade receivable, this is beginning 1/4/2016. It means it is beginning 40,000, and trade receivable it is ending. Okay. Now, how to solve this? Trade receivable turnover ratio is net credit revenue. So, credit revenue is out of 4 lakh, 80%, isn't it? Hello, because cash revenue is 20%, and
Yes, sir.
80% is a net credit revenue. Okay. 4 lakh minus 3 lakh 20,000 is your credit revenue, the credit sales. Okay. Average trade receivables, if you average this 40,000 on lakh and 1 lakh 20,000, you can get, or divided by 2, you can get this average. So this is 80,000. So what is the answer? Net credit 3 lakh 4 times. What does it mean? 4 times. This is important for you. 4 times. What does it mean? It means you can convert your inventory to net credit revenue from operation 4 times. That means your proportion to credits revenue and the average inventory. So 80,000 is your average inventory, and 3,20,000, which is 4 times more than your average inventory. That means credit revenue. So what do you mean? What does it mean? That means 4 times. It is good or bad? Or I think more it the time is, if the time is more, then it is good for organization. How? Why? Or bad? What do you think? That means how fast you receive your money from the credit sales. Okay. Hello.
Yes, sir.
That means how fast. This is 4 times. If it is 5 times, this is very good. This is 6 times, more times. That means your collection of money from the credit sales is very smooth or very fast. Okay. Then your liquidity position will be increased. Now, opposite of this trade receivable is trade payable turnover ratio. This is opposite of this trade receivable turnover ratio, receivable turnover ratio. So formula is net credit purchase. Now it is purchase divided by average trade payable. Average trade payable. It reveals average payment period. Lower ratio means credit allowed by the supplier is for a long period, or it may reflect delayed payment to supplier, which is not very good policy as it may affect the reputations. I always call this because if you pay if you pay delayed or pay very after a long period, it is not good for you. You have you expect money from others from the receivables fast. At the same time, you have to pay the money fast. Some may think that if I can keep the money to my side, it good for me because I can invest this money. But at the same time, your reputation will be damaged. Your brand value also damaged. So not delay the payment. Maybe if you keep the money, hold the money, you can use this money, but at the same time you lost your reputations or brand value of the company. Okay. So formula is net credit purchase by the average trade payable. Another problem, credit purchase during 12 lakh, creditors on, this is opening creditors 3 lakh, bills payable 1 lakh, creditors on ending creditors, bills payable on, okay, bills payable, this is opening, okay, and bill payable, this is ending. So trade payable turnover ratio, net credit purchase and average trade payable. Net credit average trade payable, creditors in beginning plus bills payable in the beginning plus creditors at the end plus creditors at the end divided by 2. That means here is creditors in the beginning plus bills payable. 2 are the liabilities, short-term liability. You have 2 liabilities, creditors in the beginning, creditors and bills payable. One credit, and what is the difference between these bills payable and creditors? Difference is one are the formal, another is not not formal, informal. Bills payables is a formal because there is a specific document you have to sign it. You commitment is that you pay this money after 2 months or 3 months. But in informal creditors, say for example you purchase inventory from on company and there is no documentation, okay, but still this is you have your debt, you have to pay this, okay. So this is 4 times, okay. The more fast you pay the money, it is benefit for your company. So from the following information, calculate trade receivable. You already done average collection period. That means you have to divide it 365 divided by 10 ratio, then trade payable turnover ratio, then average payment period. That means the difference is now you have to average to compute to convert the average collection period. You have to divide 365 divided by turnover ratio. That means this ratio is 8.18 times. If you divide this 365 divided by even is 45 days. That means every 45 days you you convert your, you collect your money. Okay, every 45 days you collect your money, and this is 123 days. Every 123 days you pay the money, isn't it? Which is not good. You collect money very fast, 25 days. Very good. It is good, not good. But for the payment, you delay, isn't it? Hello, have you got this?
Yes, sir.
Okay. I think time is 3:30. So what is the last time of today's class?
10 minutes.
3:30.
No, sir. 3:20.
3:20 and 10 minutes more.
Yes, sir.
Okay, I got this. Okay, now just last 5 minutes. Then I call your attendance. Only 1, 2, 3 present. No problem. I'll give you the attendance. This Rokeya Khatur, Nurjahan Akhtar, and Jebin Tasmin, and remaining 3 are absent today, isn't it? I think you can do yourself here, because this problem is not very difficult. You can do yourself. Okay, net asset capital. So you can do it. Okay, working capital turnover ratio. Then illustration number 18, the revenue from operation. Okay, from illustration 18, net asset turnover, fixed asset turnover, working capital. If you know the formula, you can do it, isn't it? So I think it is up to today. We just solve this up to the activity ratio. Okay, in next class we will solve profitability ratio. I think this is the last part. Okay, there in under profitability ratio there are 10 ratio, and this is very important, especially price earning ratio, PE ratio. This is called PE ratio. EPS, earning per share, very important ratio to take decision whether you purchase share or not. P ratio, prime dividend payout ratio, book value per ratio, return on net worth, or return ROI, ROE, net profit ratio, very important things. Okay, if you know, you can analyze these things, then you can take decision about the company's overall profitability, whether you invest this company or not, whether you purchase the share of the company or not. Okay, what is the how they pay the dividend. Okay, so this is very important. Okay, we'll solve it next class. After next class, this will be complete. Okay, this chapter is will be complete.
Okay, sir.
After that, you will face the midterm exam, I think. After one class, after I think after Eid vacation, there may be one physical class. I don't know whether it is physical or online. It only know the department whether they okay. But our notice is uh, 5th April, up to 5th April our university is closed. After that our university will open and class will be continue. That means physically. Okay, as so far this is the decision. Okay. Okay, and in this course you have to attend one presentation. After end of the class, I'll give you every 6 student one assignment, or one company. I will give you one company's annual report. You have to analyze it and give the presentation. Okay.
Okay, sir.
Okay, that's it from today. We'll see you next class. Okay.
Okay, sir. Assalamu alaikum, sir.
Alaikum assalam.